I want to talk about something that sounds almost insultingly simple when you first hear it, but I do think that it is one of the most genuinely effective things I've ever done for my trading. And I say that not because it made me a better analyst or because it gave me some kind of edge I did not have before. It didn't do either one of those things, but what it did was protect me from myself on the days when I was the biggest threat to my own account. And the rule is this: I set a daily loss limit and I set a daily profit target. And when I hit either one, I lock myself out of the platform until the next session. And that's it. No exceptions, no flexibility, no just one more look. I'm done for the day. And I know that sounds simple, but I also know that most traders who hear that and nod along with me are actually not doing it. Because doing it requires you to stop trading when you are up, which goes against every instinct you have when things are going well. And so I want to talk about why that friction exists and what it cost me before I had this rule in place. And there's three things that putting into practice actually did for my trading. All right, before I get into the three things, I want to address the math for a second because I think it reframes everything. You see, $500 a day on just one account, 5 days a week, is over $100,000 a year. And I'm not saying $500 is the right number for you or for everyone. The point is what that number represents when you let it compound over time instead of treating each day like you need to extract everything that the market is willing to give you. See, the version of trading that social media sells you is not the average experience. It is the highlight reel. It's the screenshot of that 5-figure day, the single trade that ran 300%, the account that tripled in a month. And those things do happen, and they're also not the norm. And when you internalize them as the baseline expectation for your trading, you're going to stop respecting the smaller, consistent wins that actually build something real over time. So setting a daily profit target was the first time I actually put a number on what enough looks like for a single day. And having that number changed how I showed up every single day. Number one, it removed the two worst versions of me from the equation. See, every trader has at least two dangerous versions of themselves. There's the version that shows up after a loss, frustrated, eager to recover, willing to bend the rules to get back to even. And then there's the version that shows up after a big win, overconfident, feeling untouchable, convinced that today is the day that you need to press harder. And I think both of these versions make really bad decisions. The difference is that the loss version feels obviously emotional, and so you at least know something is off. But the win version feels justified, which makes it, I think, harder to catch. You may be up $300 or $500 and you think, I'm clearly reading the market well today, so staying in makes total sense. But what you're actually doing is letting the morning's results tell you who you are as a trader, and that is shaky foundation for any decision. The daily limit on both ends takes those two versions out of the chair entirely. Once I hit my target, the session is over, not because the market stopped offering opportunities, but because I decided in advance that I was not going to trust my afternoon self to make the same quality decisions as my morning self. And that sounds defeatist. It's actually just honest. Number two, it forced me to take my process seriously at the start of every single day. See, when you know the session ends at a specific threshold, win or lose, you start treating your first trades differently. There's no cushion of I can make it back later, and there's no safety net of I can always keep going if the morning is slow. You have a defined window, and what you do inside of that window is what counts. What this did for me practically is that I stopped warming up with trades. A lot of traders, myself included, used to take early trades that were not fully set up just to get involved, to feel the market, to see how things were moving, and sometimes those worked out, but they were not high quality decisions. They were just low stakes ways of getting comfortable. And when the session has a hard stop, you stop being casual about how you open it. The first trade of the day gets the same scrutiny as any other trade because you cannot afford to burn part of your daily risk limit on something that was just really you getting warmed up. Number three, it changed my relationship with losing days entirely. See, when you have a hard stop on the downside, losing days stop feeling like disasters. They become defined events with a ceiling. You know exactly how bad today can get before it ever starts. and there is something genuinely stabilizing about that. Before this rule, a bad morning could turn into a bad afternoon and then a bad week because there was always a reason to stay in and try and fix it. The logic always sounded reasonable in the moment. You just needed one good trade to get back to flat. The setup is there. I know what I'm looking for, right? All these things. But that thinking is how a manageable loss becomes a damaging one. There's no stopping point, there's no recovery mode, because recovery mode does not have an endpoint built into it. You stop when you're back to even, or you stop when you have nothing left to lose, and neither of those is a real plan. Once the limit is set, a losing day is just that, a losing day. It's contained, it's accounted for, it's done. And that psychological shift matters more than it sounds on paper, because traders who are afraid of losing days make desperate decisions. But traders who have already accepted the worst case scenario before that session ever even starts, they tend to think a lot more clearly inside of it. The limit does not prevent bad days from happening. It just makes sure that one bad day can't become something you're still recovering from 3 weeks later. One of the things that makes all of this significantly easier to track is having a structured place to log not just my results, but my reasoning. Like what I saw before I entered, what actually happened, and whether my process held up even if the trade did not. And if you don't have something like that in place, I put together a free trading journal template that's going to walk you through exactly that. It's built around validating the trade before you ever enter it and reviewing it honestly after, so you can actually see where your process is breaking down rather than just your P&L. The link to download it for free is in the description. When you have a defined structure around your trading day, a ceiling, a floor, and the discipline to actually walk away at both, you stop treating this like something you do casually when the market is open, and you start treating it like a real business. And if you're serious about closing the gap between where your trading is right now and where you know it can be, the next step you should take is to watch this video right here.